G'day. Or should I say aloha? Aloha, what a great theme. Ride the wave. Ride the wave. There's a wave of financial planning that is just sweeping throughout the world, and it is indeed exciting to be able to ride the wave. How many here, if you could put your hands up, how many of you can surf? Anybody? Attempt. Okay. I think back to when I was a teenager and trying to learn to surf, and learning to surf, particularly waves like we saw at the introduction, take a considerable amount of courage. Learning to surf takes me out of my comfort zone, and professionalism in financial planning has got a lot in common with learning to surf. It takes us out of our comfort zone, it requires a lot of courage, and it requires us to do things that aren't necessarily what we're most comfortable doing. What constitutes a profession? What are the key things that will distinguish us as financial planners, as professionals? It's quite obvious that we need to focus on education, experience, ethics, and enforceability. These are the four key traits of any profession. And in financial planning, as we develop professionalism, we need to ensure that we put the necessary focus on each of those four key areas. And how do we build a practice? What do we do to actually develop our own business, our own enterprise, to ensure that we can incorporate each of those four issues in the way that we build our profession? I stop and think about it, and I think about what the most successful financial planners around the world are doing. And what's very interesting, and the phenomena that exist in my country, and I'm sure it exists here, and exists in the United States or Canada or in Europe, and that is that those professional and most successful financial planners are not those that are seeking to have as many clients as possible. When I first started my financial planning practice, I found that I was out there looking for prospects, and a prospect was anybody who was breathing. Didn't matter if they didn't have any money yet, they would have some money sometime. And so what's interesting is that as the business grows and prospers, those that are most successful are those that are focusing on having fewer clients and giving those fewer clients the optimum of service and expertise. The focus for those professionals that are most successful are those that are focusing on their clients. Always, it's the relationship with the clients that is most critical. What is very interesting, and this is particularly pertinent, is the fact that the most successful financial planners are problem solvers. They're solutions-based financial planning, not product pushing. That sounds awfully loud, doesn't it? Is that a little bit better? Okay. So they're problem solvers, not product pushers. One of the things about financial planning, that true financial planner is somebody who provides a range of solutions. The focus on the fundamentals and don't chase the fads. There are so many fads. In our country, we had emu farms and ostrich farms, sorts of interesting convoluted tree plantations and olive plantations and all sorts of fads that came along. Then we had the technology boom. We've got individually managed accounts and we've got hedge funds, and I'm sure you've got lots of these sorts of things that come along constantly, providing us with new things to sell. Oh, the market's collapsed, okay, let's come out with a product that actually can make lots of money in a down market as well as an up market. So there's all sorts of fads. One of the fads that I think is a fad, and my opinion of what a fad is probably different to other people's, but some of the holistic planning that people are talking about doing, where they walk people's dogs and mow their lawns for them as part of the overall financial planning service. Also doing a lot of work with individual clients with their, their goal setting and a whole range of other aspects outside of their finances. Some of these people are more akin to a psychiatrist, I think, than a financial planner. So what's interesting is not only should we be in the business of financial planning, of providing financial advice, but we should be in the business of being paid advice. So those are the things that we need to be thinking about. We need to leverage the partnerships that we have or the relationships that we have with financial institutions. So financial institutions should not dictate what we do. They shouldn't be wagging the dog, the tail wagging the dog, so to speak, but rather we need to, as professional financial planners, work out which parts of our business we can leverage efficiently by working with institutions that have got expertise in certain areas, and be committed to education. Overwhelmingly, the most successful, wealthy financial planners around the world have got this ongoing commitment to further study, to further education, so that we find that we never stop learning. And that's very, very critical, and that influences the way that we deal with our clients. John Bowen from Worldwide has a list of the 5 key strategies of elite advisors, and they tie in very, very similarly to the list that I had up before. The key affluent advisors focus on affluent private clients. They use a consultative process, not a selling process. What's interesting in financial planning in our country, it started out where people who were the successful financial planners were focusing on sales skills, sales training, all the idea on how we can sell products. What's fascinating is as the profession is maturing and emerging, there's a much greater focus on consultation, a consultative process rather than a selling process. Also, what we've discovered is that the most successful elite advisors are managing their practice as a business. Michael Gerber from the United States wrote a book called The E-Myth, and he talks about people being out there doing it, and they're too busy to think about working on their business because they're so busy working in their business. To step back from our business and to think about working on the business is very, very critical. The other thing is they need to partner effectively with institutions where you're in control of the relationship, where you're not dependent on the institutions to actually pay you. That's quite a contentious issue, but you can still build relationships with institutions as a relationship of equals. Money has an incredible magnetic force. You know, effectively, our loyalty goes to wherever the money is coming from. And so a lot of people in our country still argue about this fees versus commission business. But what's interesting is that most of the elite financial planners are not even concerned about that sort of issue anymore. Once again, he's mentioned they need to have a lifelong commitment to learning. So I think that's really critical, and it really does tie in with the experience in Australia and elsewhere in the world. Fear and greed. Financial planning is all about developing frameworks for people. Warren Buffett wrote this in the foreword to a book by Benjamin Graham in 1974, and it's as true today as it was 30 years ago. And that quote is to invest successfully over a lifetime does not require a stratospheric IQ. It does not require unusual business insights or inside information. What is required, however, is a sound intellectual framework for making decisions and the ability to keep emotions from corroding that framework. A sound intellectual framework for making decisions and the ability to keep emotions from corroding that framework. That, ladies and gentlemen, is what financial planning is in a nutshell. That's what we're on about. Keeping people away from their emotions, fear and the greed that comes so often when they are focusing on the wrong things. How do we do that? We need to be aware of the conflicts of interest in giving advice. Commissions and incentives that are offered by high-priced institutions in an environment where returns are likely to be lower going forward than they have been in the past. If we become a part of the solution, we need to be working on the side of the client to screw down fees and charges and commissions and expenses so that we can make sure that the consumer gets the best deal possible. That's what they're paying us for. So we need to be looking at that. The other thing that I think is quite insidious is the research houses. So many people rely on research houses to tell them which funds or which institutions to put their money into. In Australia, there's a company called Bankers Trust, BT, that's gone through some problems over the last few years. It was a 5-star rated advisor, 5-star rated fund manager about 4 years ago or 5 years ago, when it was doing really well. Its past performance was extraordinary. What's happened is, of course, 3 or 4 years after you would have put your money into that 5-star advisor, last week, all the research houses came out with a sell recommendation on it. They were shutting the gate after the horses bolted. That's the problem with so many research houses, with so much which goes to be called research in this profession, in this industry. It's not research at all. It's just recentism. Looking at the past performance, being so glued to what's happened in the past so that they're easy to sell, things that have gone up in value in the past. And this sort of research encourages us to buy high and sell low. And it's nice and easy to do it. And we know, even the taxi driver knows, that you're buying things when they're low and selling them when they're high. But all the pop research that we subscribe to doesn't go anywhere near providing real sound economic, education and evidence-based information about what's really going on in capital markets. So we often get caught up with just recommending what the researchers have said. The other thing is the press. And I don't know how many of the press are here today, but the press demands that we as financial planners give them hot tips. You know, I get on a plane to come here and they say, "Oh, you're a financial planner. Well, what's going to go up next year?" I said, I'm a financial planner, I'm not a guru, I don't have a crystal ball. And yet, we're constantly called upon by the press to give hot tips. Somehow we've got inside information. Somehow we've got unusual business insight. Or somehow we know something that the rest of the market doesn't know. And so the press and the media are just as much to blame for the downfall of so many investors as the research houses are, or the salesman who's selling the thing that has been going up most recently. And so the sales culture, which is based on delivering what people think they need and what they want, rather than what evidence proves they indeed need. That's what financial planning should be all about. Financial planning should be the difficult sell. Financial planning should be about giving people the reality check and not saying, my goodness, now's the time to be buying this because it's gone up by so many percent. What I believe our role as advisors is to apply academic research to the practical world of investing. Our objective must be to help clients with a no forecasting investment philosophy. We need to add value through portfolio engineering, and we need to make sure that that is consistent with the objectives. We need to know what our principles and our beliefs are. Every one of our practices should have these enshrined and put up on the wall. All of our staff need to know what are the principles and beliefs of this firm. My first principle, or the belief that I use that serves me well, is that capital markets are efficient. Capitalism works. Amen. Capitalism works. For investment purposes, this principle or this belief is very, very useful. Okay, there are times when capital markets are not efficient. There are times when there's some craziness. But the thing is you don't know when those craziness times come about. That those inefficiencies sometimes are too great and sometimes too low, and that speculation happens all the time, and it's very difficult, almost impossible, when you've got so many expert analysts looking at the same investments. If you've got a part of a market which is, say, venture capital, which is not heavily regulated or heavily researched or heavily assessed, then you may get some much greater inefficiencies there. But the greater the scrutiny that goes into a market, the more chance that what you're guessing is undervalued or overvalued is wrong. Because the market is the sum total of everybody's guess, everyone's estimation, everyone's assessment, everyone's analysis. So from an investment point of view, if capital markets didn't work, if capitalism didn't work, then those entrepreneurs who are providing the business and those investors that are providing the capital to those entrepreneurs are not properly matched, and the middleman's going to make all this money. Somehow the cheats and the crooks and the inside traders and the actual intermediaries get all the money, and the people who start companies and the people who are actually providing the capital to companies are getting a bad deal. And I don't believe that's the truth. I believe that capital markets are efficient. The second core belief is that risk and return are related. I use this as a belief in our practice. There are price risk factors that determine return. You know, put your money in the bank and you'll get 1% above inflation. Put your money into property over a 20, 30, 40 or 50-year period, you'll get about 5% above inflation. That's what property does everywhere in the world. I don't even know what property prices are doing in Malaysia. I probably don't want to know. But the fact is that over very long periods of time, property will perform with inflation. It grows as rentals grow, as the cost of rebuilding properties grow. It's a fantastic hedge against inflation. It gives you 5 times the return of putting your money in the bank. And shares are riskier again, and they give you a return of about 7% above inflation over the very long term. And the thing is that these price risk factors determine return. There is no such thing as a capital guaranteed 20% return that we see advertisements about in the newspapers, and I'm sure you have the same things here. Once people understand that, once financial planners understand that, our clients can be better served because they have better frameworks in order to develop their long-term investment strategies. Diversification is essential, is one of my core beliefs. Diversification is the antidote to uncertainty. Concentrated investments add risk. If you only have 4 or 5 stocks in Australia, we've got banking stocks that have done so well. So people say, well, look, all I have to do is put my money in bank stocks. I've got 6 or 7 stocks that's done better than this diversification you call it, diversification that you talk about. But people do think it's diversification. Diversify internationally. The Malaysian share market has been one of the best performing markets in Asia. And you, as good financial planners, have told people they need to diversify internationally. They think you've got rocks in your head because of the short term where you've actually benefited from not diversifying. In Australia, we're the same. Our market has performed extraordinarily well. The one area that has let down every investor is that area of international investment. The US share market, the Japanese market, and the European markets over the last 2 or 3 years. So then now people say, well, diversification's dead. Just buy some good stocks. And yet over 10, 20 or 30 years, you'll find that there is an incredible increased risk there. Sometimes risk is present and you don't even know what it is. But if you're getting a return of 8 or 9 or 10% above the bank bill rate, or above what other shares are getting, or above what property is getting in each of those sectors, and you don't know what that risk factor is, it's there, but it's hidden away. It'll sneak up and bite you on the bum. So you've got to be very, very careful. Diversification is very, very important. The structure of your portfolio explains performance. This is a belief that we have in our practice. In order to give professional financial planning advice, we need to refer to these 5 key issues. That structure, the asset allocation, is where return comes from over time. It is certain over time that you'll get a return from different asset classes. Even times when you find that shares have actually performed badly, that's normal and a normal part of the process. We need to understand where asset value comes from. This is quite revolutionary. It should be so basic and so fundamental. But the thing is the net present value of all future income is what people will pay for something. And it's factored into the price. Sometimes that's valued optimistically, sometimes it's valued pessimistically, but it's always what people are prepared to pay for something. So whether it's shares or property or bonds, that's what the value is of something, and we need to actually understand that valuation. Jack Bogle, one of the great investment gurus or great investment people of the last half century, put together this chart, which I find is very, very interesting. He's actually broken down the return from shares over the last 100 years. And let's have a look at the way that he's put it together there. Effectively, the bottom line here, the market return, what we've got is a situation where in the first decade of the last century, the share market in the United States of America got a 9.1% return. He broke that down to say that the dividend yield, the earnings of the United States share market over that first decade was 3.6% per annum. The earnings growth was 4.7% per annum. So that really the investment return from shares in that first decade of the last century was 8.3%. During that first decade of the last century, people became more optimistic towards the end of the decade than at the beginning of the decade. So what happened was the earnings multiple, the price-earnings ratio, increased as people got more optimistic. And it added about 0.8% to the return because the dividend was 3.6, the earnings growth per annum was 4.7, therefore the speculative return, the amount that people were prepared to pay over and above that, was 0.8% of that 9.1% return. In the next decade, from 1910 to 1919, people became considerably less optimistic. Does anyone know why? So there was the Great War. And so what happened during that decade, the dividends were 5.3. The earnings growth over that next decade was only about 2% per annum. The earnings were growing by. So in fact, the investment return during the next decade was 7.3%. But the multiples or the PEs contracted over that decade, and so the actual total return from US equities was 3.9%. So because of pessimism, what we found was it whacked off about 3.4% per annum off the total return, so that the market return was 3.9. During the 1920s, there was far more optimism. The dividends were about 6.2%. We had the technological revolution of the 1920s. Motor cars, aeroplanes, radio. RCA was one of the hot stocks of the US share market in the 1920s. This was the technology boom bar none. Things are different this time round. The earnings were fantastic, 6.2% during the 1920s. Earnings growth, companies could do very, very well as they applied this new technology, so it was 5.6%. So the investment return was 11.8. What's interesting is people's optimism added a full 3.3% per annum to the return in the 1920s, meaning that the average investor in the US market got a 15.1% during that decade. 15.1. Of course, we know what happened in the 1930s and then of course, the 1940s and so on. But what's interesting is the entire decade in the United States, the return of the United States share market was 4.8% attributable to the dividends, 4.8% per annum earnings growth, making up a total investment return of 9.6%. But of course, the speculative return, the PE multiple increase or decrease, accounted for about 0.5%. And therefore, the total return for the last 100 years in America was 10.1%. How many of us spend how much time trying to work out the speculative return when over the long haul, the earnings and the earnings growth is what's going to give us the return. And that return, when inflation was about 3% over the last 100 years in America, was about 7% above inflation. What's interesting is that the 1980s and 1990s had very similar earnings and earnings growth to the long haul, but the speculative return went off the planet. So that we had massive returns of 17.3 and 17.8% consecutively for each of those decades. What is going to happen going forward when multiples are trading historically at well over 20 times earnings, when the long-term average is about 15 times earnings? And so Jack Bogle put together a couple of figures based on that, and I've used Australia and the US, so I didn't have the figures for Malaysia, but I'm sure you as financial planners could do this same analysis here. And you can find that in the United States, from 1990 to 99, the earnings were 3.2%, the earnings growth was 7.4%, and then the speculative return was 7.2%, giving a 17.8% return. In Australia, the earnings were 5.8%. The earnings growth was 1.9% per annum over that period. We didn't have the same earnings growth as America. Our speculative return was nowhere near as great as America, it was only 4.6%, giving Australian investors over that decade an 11.9% return. Moving forward, assuming that the PEs only come down to 18 times, not 15 times earnings, so they're coming back towards the mean. I don't want to be too pessimistic. The fact is, dividends in the United States at the moment are 1.5%. The earnings growth going forward, according to Bogle's figures over the next 10 years, he's estimated to be about 6% per annum. Still pretty healthy. But he's talking about a minus 2.5% per annum reduction in the multiple, so that the long-term return from US equities is only likely to be about 5%. And of course, in Australia, we've looked at it, 4.5% earnings, 5.5% earnings growth, about minus 1.2 because we weren't so overvalued as the US on the multiple, giving about an 8.8% return. These are the figures that I can then sit down with investors and talk about what the long-term return on investment is from. It's from earnings. It's from earnings. It's from earnings. If those earnings are growing, you pay a little bit more for those earnings than if they're not. Whether people are pessimistic or optimistic means that people are paying too much at some period and too little at other periods. Ultimately, these sorts of things wash out over the lifetime of our investors. So it's really important to have that principle behind what we're doing in our practice. When we think about what we as CFP practitioners do and how we run our business, we need to start with ethics at the core. Trustworthy advice, worthy of trust. The reason that individuals will come to see financial planners is only if they trust them implicitly. If they see us as salesmen and product pushers, they will not trust us. If they see us as people pushing the latest fad and staking our reputation on being able to predict the future, they will not trust us. If they see us as professionals developing a framework with them, giving them the understanding of how they get return, then we will build trust and we will build a reputation and we'll be a true profession. But that can only come from ethics, putting the client's needs in front of our own. And with that as our core, we then need to develop our skills and knowledge. We need to research history. We need to know what has gone before, and we need to know what the long-term trends are, and we need to have an understanding of what's going on. We need to then understand the regulations and the legislation that we work within. We then have to make sure that we comply with all the rules and all the requirements there. And we need to make sure that we're running our practice as efficiently as possible to incorporate all of these factors. We need to be thinking about, as financial planners, how we can actually build a team that encompasses all of this. And that team must be built based on our values. That's what our investors, that's what our clients are going to be buying, is our value system. They need to understand that our culture comes from those values, and our behaviour reflects those values and reflects that culture, and we develop a vision that those investors, that those clients can embrace and that they can own, that they can make it something that is theirs. Worldwide, my experience has been that financial planning practices are struggling with the same three key issues. That is how to grow the business. The next issue, after you've got the business up and running and growing, is how to manage that growth. And the next issue is how to exit the business. It's interesting that financial planning in the United States, in Australia, in some of those areas which have become more mature, we're now experiencing the phenomenon where people are wanting to exit their business. And there's lots of people that are prepared to actually buy those businesses. A lot of them are institutions. And that's okay, because a lot of the institutions have got a lot of CFP practitioners operating within that practice. If those institutions lose those values, lose those core beliefs, lose that culture, then they will come on very, very hard times. Because what will happen is the consumer, who is becoming increasingly empowered because of technology, because of information, because of regulation, the consumer is not going to take it anymore. So we need to actually go through that process and think about the way that we manage our practice to grow it, to manage it, and then to be able to exit successfully in such a way that our clients are going to get a continuation of service in the way that we envisaged originally, so that we can be true to the promise that we made to them. I just want to go through a case study of my own practice, which I commenced nearly 7 years ago, 6.5 years ago, and we're committed to change. One of the things that we made as a policy early on was that we would be agents of change, not victims of change. Agents of change, not victims of change. If you want to fight the wave, you'll get dumped. It'll crash you into the sand. If you actually decide that you're going to make a difference in the world, and if you decide that as part of your core beliefs, you're going to bring about change, bring about benefits for the consumer, bring about the sort of financial planning environment that you believe investors deserve, then you're at the forefront. You're not dragged kicking and screaming in becoming a CFP. You're not dragged kicking and screaming into getting your practice organised. You're not dragged kicking and screaming to do what the regulators and the government is enforcing upon people. In fact, you're way ahead of the change. You're part of the solution, not part of the problem. So we actually made that as a core principle. We looked at the principal risk. What happens if I get hit by a bus? Can the practice just be reliant as a small business on one individual? So as an independent financial planning practice, we knew very quickly we had to exit me from the day-to-day running of the business so that I can come to Malaysia. And the next thing we had to do was we had to be prepared to make the hard decisions. We had to think outside our comfort zone. We had to think about where things were going to be in 5 years' time before they actually happened. We believe that there's going to be a trend to lower returns. In Australia, a lot of advisory firms use wrap accounts and master trusts. The cost of these administration systems is in excess of 1%. The cost of funds management is in excess of 1%. And the advisor wants to get a fee of about 1% a year. That's over 3% in total ongoing fees and charges that need to be fully disclosed to the investor. I believe that in 5 years' time, investors will know what that 3% is in total, no matter who they go and see, that the public will become well aware of that. It was okay when you're getting returns of 18%, or maybe it was okay, maybe it wasn't. But if people are getting 18% and paying 3%, they still got 15% return. If people in a low inflation, low return environment are only going to get single-digit returns of 8 or 9%, and they're going to pay 3% in fees, they might as well go home. If we participate in that environment, then we're part of the problem. Therefore, we had to get out of our comfort zone and find new and better ways to do things more efficiently. We had to work with institutions that were prepared to share that philosophy. We had to find ways of using technology to actually develop platforms and systems that could do things more efficiently and get away from a lot of the legacy systems that were keeping prices so high. We had to do a lot of capital expenditure, and we had to critically appraise our business as to what we were doing and why we were doing it. We were established in 1996, the beginning of 96. We've now got $230 million in funds, just $240 million in funds under management. Our revenue last financial year was $3.6 million. And our profit on that was about $850,000. Our profit is growing each year, and we're focusing on the profit, not on the funds under management. That's an old way of looking at things. Our total staff now are 18, but we're looking to actually take some extra space where we'll be expanding that to probably about 28 or 30 over the next 12 to 18 months' time. Our number of clients is 750. Our average funds under management per client is about 300,000. But what's interesting is our average new client last year was 550,000, and to date in this financial year it's 750,000. So our average client size is growing much larger, quite dramatically so. We look at what our revenue streams are and diversify those streams. We've got a consultation business where we charge fee only. We then have a plan and implementation business where we charge fees only, and we have no commissions for placing investments. We then have a client advice and review business. What's interesting is people come along, they pay us for consultations, they pay us for implementation, and they pay us for review. So each one of these legs are feeding into another, so we've got different sources of business. We don't accept any ongoing trailing commission institutions which could compromise our independence. We then have an administration business that we've established which uses a wrap account, and that technology we've been able to sell to other advisory practices. So that's another stream of business that we have. We've then got a media and public speaking business where I'm no longer involved day to day in the practice, but I'm out talking to the members of the public about financial planning, about wealth creation, about what works when they're getting so much from the media that's misplaced and chasing the fads and chasing the hot tips. I'm actually in quite a lot of demand in Australia to be out speaking at different conferences for different organisations, and what happens is people are learning, wanting to know more and more about the financial planning process, and I get paid for doing that work. What it does, of course, is that then feeds referrals from the conferences that I go to that come to see us about consultation. They come to see us about getting plans developed. They come to see us and then pay ongoing review and administration services. We've got external business development section where I'm writing a book on financial planning at the moment. That's under our external business development revenue stream. But what happens is once people buy the book and they understand what financial planning is all about, then they come and see us for some consultations. And so the whole circuit starts going through again. So they all feed on each other. We've got that referral business where we're referring business in from solicitors and accountants and solicitors and other like-minded professionals who are working with us. What's interesting is as we've grown our business over the last 6 or 7 years, we started obviously from a zero base, and by June 1996 we only had about $2 or $3 million of assets, but we've been able to grow that quite successfully over the last 6 years or so. What we've developed is a centralised decision-making process. I and my wife started out our business with a filing cabinet, second-hand of course, $150, a second-hand desk, and I pinched the paintings from home so I could put them in the office. And after 6 months we put on a receptionist so my wife didn't have to do it. And we've got 6 young children and we've got a foster child, so my wife's very busy at home. But she really put her foot down when I brought the laptop computer into the maternity ward and said she really needed to do this plan for me. So we did it tough for that first year or two. But we had a philosophy and we actually gradually introduced others into our business. I invited 1 or 2 of my key staff members to join our board of directors and to buy a part of our business, when now we're at the point where we're selling down 5% of the value of our business to staff every year for the next 4 or 5 years. And then my wife and I will be left with about a 60% holding in the business, and some of our key staff will own the other 40%. What's interesting is the valuations that we've placed on that were based on the fact that we've been growing quite dramatically, 35% per annum. So what happened was we said, okay, we'll sell it for 10 times last year's profit, which is about 7 times next year's profit. And each year the profit has been increasing quite dramatically. So this last financial year, where the profit was $852,000, 5% of the business value was $426,000. And the interesting thing was that the number of our key staff that are jumping in, and it's oversubscribed in the first week. And so that values the business at $8.5 million, but they all want to buy a slice of the business because they know that if we meet target for this financial year we're in the middle of, and we look like we're going to exceed target, the actual profit target is $1.2 million, so 5% will be $600,000. So they're wanting to get in now before, in year 5, according to our target, the profit is $2.7 million, and so they'll have to pay $1.35 million to buy 5% of it. So what's happening is there's a desire of the senior staff to actually become part owners of the business. What's interesting, I've got one of my key staff is 29 years of age. He's getting married next Saturday. And he owns 12.5% of the business, and he'll make $150,000 in dividends from the business, and he only gets a $120,000 salary. So he's making already more from dividends than he is from salary. And what's interesting is he could actually quit work tomorrow and never work again, and that dividend, if we go according to budget, would continue to grow quite dramatically to where he'd be making several $100,000 a year, and so he could retire at 29 years of age if he chose to. So what we do is we get together we've got a board of 4 of us, there's myself and 3 others, and we do the analysis of the monthly business performance. We actually look at our profit and loss reports every month. We look at our balance sheet every month. We look at our outstanding debtors. We compare the actuals to the budget year to date. So we had a really interesting meeting this week, a few days ago, about the fact that we were slightly below budget for the month of September, or the end of August. But I've been reassured and guaranteed that there's about $17 million in the pipeline, you've heard that one before, for the end of September. But we're scrutinising it to make sure we meet our long-term targets, and we're very serious about it. We have business performance indicators for new funds under management, for open accounts, for closed accounts. We have advisor performance reports. We have staff and resource issues that we're constantly analysing. We have our compliance manager that's looking at the training needs analysis for all of our advisors and how we're going to continue to develop the very highest calibre of advisors to deal with the very high net worth clients that we're increasingly looking after. The strategic planning that we do, we look at that every month, and every 6 months we go away for 2 days off-site where we actually do that SWOT analysis, and we look at where the business is going longer term and what the new revenue opportunities are, so that we can continue to diversify our revenue streams. We look at marketing proposals, and one of the things that we've done at the Money Managers is we've ensured that we've actually been paid for all of our marketing. So whether it's being paid to do work on the radio, being paid to write columns for newspapers or write articles for magazines, being paid for speaking or writing a book, or all these sorts of things are part of our PR or marketing, and yet we haven't had to spend $1 on getting our name or brand known. And so that's very, very important, that the different activities that we do should all lead people to build relationships with our business. One of the things we've developed is a business unit format. As I handed over the day-to-day dealing with most of the clients, except for a very small few close friends and people, we've actually developed a close team where the clients see me and understand that I'm supervising and giving the overview, but it's more of a governance role. I started out in the business as the technician, as the financial planner. Gradually, I got more and more involved in management, and I found that I didn't enjoy management. I was having to do all the hiring and firing and having to order the coffee and, you know, do all the stuff that you get involved in, and that's a different skill base again. But what I found has been fascinating is the ability to be involved in governance. And being on the board of directors of the Financial Planning Association has been a great training ground for me, where I'm not executive in the Financial Planning Association, I'm actually running my own business. Yet the direction of the association, or the general understanding of where we need to go and what needs to be done, is being developed by the board of directors. What I've done in my own practice is implemented a governance structure, where at those monthly meetings, we determine the direction of the practice, and then I appoint the compliance manager, go off and you do that and you're accountable. The director of financial planning, you're accountable. The operations director and finance director, you're accountable. These are the things that need to be done and need to be brought to the next month's meeting, and goodness help us if it's not done. So what happens is we can have the philosophy, we can have the overview, we can have the whole vision that can be permeated, but my time isn't taken up in the day-to-day machinations that we get caught up in. Anything that can be delegated is delegated. I now work in my practice 3 days a week. I spend more time with my wife and children, and I'm the Honorary Consul General for East Timor. So I represent that country in Australia. So that all of these things are only possible, as well as a lot of work that I do in my church organisation, because of the time that is freed up by having an organisational structure that allows other people to do the work. But with the business unit format that we've developed, the client has got contact with a dedicated small team so they don't lose that one-on-one. That small team has the intimate knowledge of the client and their circumstances, and the staff contribution and involvement is absolutely optimal in that environment. We're very focused on decreasing human error and jotting down everything. If it's not written down, it doesn't exist. Every single conversation, every single telephone call, every meeting is documented in our systems. We've got, we started off with one business unit with 2 financial planners and an assistant financial planner, 2 administrative assistants and then a receptionist. We've now developed 2 business units, and what those business units can handle is about 380 clients each. About